Hi, everybody, and welcome to the Wall Street Report. I'm Jennifer Schonberger. The market hasn't skipped a beat all year, but how long can the party last? Joining me now is one of the best market timers on Wall Street. Larry McDonald is Chief U.S. Equity, Fixed Income, and Political Policy Strategist for Newedge. He's also the author of the New York Times bestseller, A Colossal Failure of Common Sense, the inside story of the collapse of Lehman Brothers. Larry, welcome back to the Wall Street Report. So great to see you.
Hi, Jennifer. Thanks.
So, Larry, you follow 17 risk indicators. What are they telling you about the state of the world now?
Well, it's really a tale of two cities. Out of my indicators, these are they've been very predictive of market declines the last 3 years. And some of them are sentiment driven, and some of them look at systemic risk and deeply. And the systemic risk overall, in terms of those indicators, is down about 50% from last year. So this time last year, you had Greece threatening to leave the Eurozone. You had the French elections, and Sarkozy was replaced by Hollande. And you had tremendous disruption from Europe. Now today, the systemic risk indicators are lower. This is sentiment indicators, which aren't as important. They're important, but they're not as predictive. They are screaming sell. They're screaming get to the sidelines, wait for some fear, wait for a better entry point.
Yeah, yet we really haven't seen anything trigger a sell-off so far this year, right? It's been a straight move upward. You think the Fed is really the key to a potential market sell-off? And what I mean is the potential for tapering?
Well, I think going on behind the scenes, something very interesting happening. Like 90% of investors, conventional wisdom today is that the dual mandate, which is 2% inflation versus 6.5% unemployment, the Fed's going to keep QE on until that point. If you look at the PCE inflation number, that's down at 1.1% in March. And what's bizarre about that, Jennifer, is that's before the April debacle in commodities. The commodities were annihilated in April. So if anything, that PCE number is going to come down in April. So you're talking about a PCE number that's 100 to 110 basis points, maybe 120 basis points below the Fed's dual mandate. So that tells the average. I think the average idiot might think that, well, that the Fed's going to just keep printing until 2% inflation and 6.5% unemployment. We're nowhere near 6.5% unemployment anyway. So that, I think, is giving the market a false sense of confidence that QE is going to have full throttle, pedal to the metal. But what I'm hearing behind the scenes is these deadly cocktail of side effects of QE, which I'll get into, are going to force the Fed out of QE. So
do you mean the so-called bubbles that perhaps are forming in the bond market and the stock market?
Yeah, so the point I'm trying to make is, what good is 6.5% unemployment if the end product of that are socially disruptive side effects? High-profile hedge fund managers have met with the New York Fed, and they're very concerned about some of these. There's multiple bubbles.
So, Larry, I mean, when do you think the Fed is going to pull back, or is going to be forced to pull back as a result of unintended consequences from its policies and what is brewing right now in bonds and stocks? You think they're going to begin to taper sooner than perhaps market participants think?
Yes, and exactly. I think it's dumb. I think it's naive to look at the dual mandate and focus on that. That's just crazy.
And what consequences is that going to cause within markets? I mean, are we going to see major sell-offs in stocks and bonds?
Well, stocks are overbought here. I mean, if you look back on any sentiment reading, the Barron's piece, stocks are there's more bulls today than at any moment in 30 years. When everybody's bullish in general, it's not a great time to be playing around in the stock market. You're much better off waiting for some fear. But in terms of what they're going to do, I think that here's what's going on. The high yield market, I was a trader years ago at Lehman. I traded high yield bonds and distressed bonds. The amount of money that's come into these ETFs and these high yield ETFs and these leveraged loan, these fixed income bond funds is up 70 to 80% since 2006. But the street's ability, Wall Street's ability to provide the high yield market liquidity. The balance sheet the street has is down 80% from 2006, 2007 levels. So you have a much bigger bond universe, and you have a much smaller Wall Street balance sheet universe because of Dodd-Frank, because of Basel, because of the Volcker rule. If people need to exit the high yield market in any type of meaningful way, there's no bid there. There's not enough bid to provide liquidity, which can create elevator shaft drops, and the little guy's going to get hurt.
When do you foresee this perhaps playing out?
I think before the end of the year, probably in the third quarter, the Fed will take down the QE from 80 billion to say 40, and they'll start to, you'll get a smaller number there in terms of what they're actually purchasing each month.
And would that create finally a fall in the stock market, you think?
Well, it's already starting to play out. The dollar is ripping. I mean, commodity prices are getting crushed, not just because of the softness in the Chinese economy, which we can get into. The Chinese economy is probably, 2% overstated in terms of their GDP growth right now. But commodities are really getting hurt as well because of the dollar strength. Why is the dollar so strong? Because it's viewed right now that the U.S. is going to be one of the first countries to come out of this.
Right, the tapering purchases. So
Yeah.
I guess my question to you then, Larry, is if I'm an investor in the stock market now, what do I do? Do I hold my nose and get in while the music's playing? Do I go to cash? Do I wait till later in the year, in the third quarter?
I'd say the average person, nothing wrong with having, 40% of your money, 50% of your money in stocks, but have a good amount of cash because, as I've said before, since Lehman, the best purchases in the market have been at times of fear. Now, if you said that 2 months ago, you missed another 3-4% on the market. So what? You can easily get that back. Between September 30th and November 16th, the market dropped close to 7% on political fear. You could easily have something like that develop over the next couple of months. I just think you're better off with being in the market, having a lot of cash, and I just think waiting for that fear moment.
Larry, what are your top 3 best investing ideas now?
We've done a lot of work on the mortgage space, the mortgage insurers as well as the GSEs. We've had clients on the hedge fund side in GSE, the Fannie and Freddie trade for the last year. And I think it's one of the great politically driven trades I've ever seen. So if you spend a lot of time, if you really dig into the politics of it, I think that can give you a little bit of advantage over the market. I think at the end of the day, it all comes down to this. Fannie and Freddie's balance sheet, the U.S. Congress over the next year is going to privatize Fannie and Freddie with a public backstop. Fannie and Freddie have to get a lot smaller because, as I talk about in my book, Philosophy of Common Sense, Fannie and Freddie used to be a 64 times levered company that owned mortgages. The Congress wants to take that leverage down, make Fannie and Freddie smaller. That's going to increase the need for mortgage insurance. This is one of our most successful trades, but it's highly bought into right now. A lot of people are starting to get on the train, but I still think it's got 2-3 years of a secular positive change where you've got trillions of dollars that Fannie and Freddie is issuing a year. They need help in terms of insuring those mortgages in the private sector.
Right.
And the mortgage insurers like MTG and Radian are there. I'm very positive on this sector for the next 3 years. I do think it's overbought. I do think, say these stocks could easily fall 20-30%, and you could add to a position there.
What are 2 other ideas that you have right now, Larry?
Well, I'm really negative on oil. I think that I don't think that oil has caught up with the rest of the commodity space.
So you're shorting oil now?
I'm short oil. The secular change in the commodity super cycle is here. It's here to stay for the next several months, if not year. And the short the Canadian dollar, short the Australian dollar trade, we've had that on with recommended that to clients over a month ago. This whole commodity super cycle trade, that unwind is my best idea right now.
So then, Larry, if I'm invested in cyclicals, right, because we're starting to see market participants shift or rotate into those more economically sensitive sectors like materials, stocks that track commodities, are they poised to lose their shirts?
Oh yeah, I mean the material space is the other side of the mountain. If you remember the 90s, the internet stocks after 2000, all those stocks were on the other side of the mountain. You know, the Yahoos of the world, the Cisco's, higher highs, lower lows. They haven't formed bases. You never want to make a meaningful investment into a sector that's making, I should say, lower highs and lower lows. Excuse me, with the tech space from 1999 to 2002. So you saw lower lows, lower highs, and lower lows. And here in the material space, you're seeing the same thing. Lower highs, lower lows. It's a secular change. It's a massive change. So that sector, I think, will continue to have vicious short covering rallies and lower lows.
Larry, thanks so much for your time and insight. I so appreciate your coming on the show.
Oh, thanks. And my Twitter handle's @ConvertBond. And my website's lawrencegmcdonald.com.
That's right. We got to get in a nice plug. Larry McDonald, Chief U.S. Equity Fixed Income and Political Policy Strategist for Newedge.